So what are your expectations for the jobs report? We're going to talk much more about it later in the show. Do you think that the jobs report meets expectations? And is this still a market mover, even though we actually just heard from Jay Powell at the Deal Book Summit this week? And also, it seems like this cut in December is pretty much baked in.
I agree with that. I don't know that barring another big swing, either positively or negatively, it's really going to change what the market has priced in. I think what we're going to be looking most at, frankly, is what's happening with wage growth. Because if we anticipate how the U.S. economy might evolve next year, of course, we, the Fed, still very much focused on inflation, on services, and on wages. And if we do see a market that still is relatively constrained, i.e. maybe there's an uptick in wage growth, that would suggest if subsequently there are more immigration restrictions in the U.S. or any other measures that might restrict labor market supply, that could feed through to wages and ultimately to inflation, and that will certainly be a concern for the Fed.
You know, Dan, let's talk this through a bit. The estimate for wage growth for this upcoming report's 3.9%, very slight cooling from what we saw during the last one, which is like 3.99%. Essentially 4% wage growth year over year. What does that mean for investors? Is that something you think investors need to be concerned about when it comes to the equity markets? Because we have heard some companies in the food and beverage space and hospitality space talk about having to raise prices due to those wages.
Well, you know, we're now in an environment where we've got wage growth and inflation a little bit more in line. Core inflation in the U.S. is running about 2.8%. If we do get this 3.94% wage gains, you at least have 1% real wage growth. So I think certainly in terms of consumer demand, that's going to be supportive after having to go through several years where you had negative real wages due to the high inflation previously, thanks to COVID. So from a consumer point of view, should be supportive and positive. In terms of corporate profits, you also have to keep in mind, what do we see on the productivity side? And here, you know, we can mention AI. Does ultimately this help companies work more efficiently? But, you know, ideally, companies should be able to support that differential between wage growth and inflation if they're able to generate more productivity with the workers that they have.
All right, let's get back to the markets. I know you're bullish on small caps right now. We're going to show a chart of small caps since the election. They are a leader. They're leading the S&P and the NASDAQ 100, I should say. But when you look, it's actually changed just not by a lot, but small caps actually trading in line with the NASDAQ 100. Is that surprising at all? Small caps, a cyclical sector, expected to benefit from rate cuts, also benefit from the sentiment that we're going to do more domestically, that we're going to have tariffs. The thought is that they would be beneficiaries, but they're really trading kind of in line with tech and not that different from the market. Is that a surprise to you? Do you see that changing going forward?
Well, I think it's a matter of perspective. I mean, we appreciate or anticipate over the medium term, really, that tech is going to outperform. I mean, that earnings growth that you have within the tech sector, that really should drive prices, and we don't see valuations so stretched. The comparison then for small cap really should be towards, say, the non-tech part of the S&P 500. Think about Russell value. And there, I think if we look at the comparison, small cap holds up better. We would anticipate high earnings growth from small cap relative to that part of the market, relative to value next year. And we do think that is going to be supportive for price gains.